Hey, this is Spencer with Numbers Up Finance, and today I'm just putting out a video that gives my very broad perspective of where I'm expecting the market to go in the future. Um, in this video, I'm going to be looking at the daily, the weekly, and the monthly charts for SPX, which is the S&P 500. It's just the general benchmark that most people use to gauge how the market is doing as a whole. But we'll start off with the daily chart, right? So what we've got here, we've got the daily chart where each candlestick it measures 1 day of movement in the market. And this goes all the way back to just after 2014, so we've got a couple years. And the big things that I wanted to point out, I'll just start off by saying this. First of all, my overall perspective, my very long-term perspective, is very bearish for the market. But now I'm talking months and years here when I say bearish. My very near term, meaning like the next couple of days leading into the end of the year, I'm expecting a bounce, a bullish bounce that is, where we move up. I can't put an exact percentage, but maybe 8 to 10%. I'm expecting a pretty strong rally towards the end of the year, but we'll get into that later. The first thing I want to point out, right now we are at a very, very, very key level, right? We're currently testing the annual lows for SPX. Right now we are parked directly on the level that we were at earlier this year in February. I've got these two lines here. This is kind of like a support zone where I would expect a reversal. We might undercut it a little bit. Part of me was expecting to reverse back here. You could see the small little green candlestick that reversed just at this first level of my support zone. But we ended up, it was a bull trap, right? We went up a little bit for a couple days and we came right back down. But that's natural. That should be expected in a volatile market like what we have now. But right now, we're testing the lows, the annual lows, which is a very big deal. I'm 100% expecting, not 100%, I should never say that. You can never 100% accept anything in this market. But right now, the technical analysis on the daily chart is incredibly bullish. Currently, I'm positioned long, but I'm also a very active trader, so you have to take that into account. And when I mean active trader, I mean that I'm planning on being long for a couple of days, at most a couple of weeks to the end of the year. And so you have to make that decision for yourself when you're doing your own analysis as to what your risk tolerance is, what time frame you're looking to trade, how actively you check the prices, everything like that. I'm I'm very much so a fan of active trading, although I don't day trade. I'm not that active. I do monitor the prices very frequently, so this is right up my alley for going long here. But we'll start right. So we have the support zone. I already mentioned I'm expecting a balance. My maximum target would be to move back up to this green line. This green line represents the 200-day moving average. So that it's a relatively common used moving average, the 200-day. A lot of eyes are looking at it. We can see that for the past couple of years, the 200-day moving average has been an incredibly accurate support for this bull market that we've been in. You can see these blue circles. These are tags off of that 200-day moving average. You've got 1, 2, 3, 4, 5, 6. There's a couple others here, but they're not clear enough, and they kind of overlap with each other. But moral of the story, the point is, for a couple of years now, for about 3 years, it's been an incredibly strong support that we've broken. And we've broken it before, as you can see. There were these two times, these two periods back in early 2015, late 2014. We were below them, but the thing is, we regained them very quickly, right? This is about, I don't know, what's that, 2 months or so, and this is again about 2 months or so, and now we've been in this. I don't want to call it. I'll call it a pullback. It's not quite a bear market yet. We haven't reached that 20% threshold. But right now we're incredibly below this line, and it's not looking like one of these past pullbacks that we had, one of these past drawbacks or corrections, where we pull back for a little bit, we're there for a couple weeks, couple months at most, and then we get right back up. We would have a lot of work to do in this market to get back to there, which that leads to my longer term outlook, but we'll get there. I'd like to point out we have very strong, incredibly strong bullish divergences right now. And if you don't know what that is, it means when the price is making lower lows, which is what it's doing now, but the momentum indicators, the momentum of the stock is going up. So MACD, RSI are two of the most common, most popular momentum indicators that you have. And you can see these green lines that I have here. These represent that the momentum is going up. As you can see, the lows are getting higher and the highs are getting higher for the momentum for the MACD crossover. MACD is just basically a comparison of the moving averages, but that'll be for another discussion. So the momentum's going up, the price keeps going lower, And that generally indicates, at least for indexes, stocks can be a little bit different. But for most of the indexes, when you have on the daily chart, when you have a divergence, either bullish or bearish, it almost always plays out and indicates a reversal. And you can see that these red lines indicate bearish divergences, where leading up to this previous pullback that we've had, we kept making higher highs, but the momentum indicators are pointing downwards. Bearish divergence, likewise, it played out very nicely. We're down about 15% right now from when that started. You can see earlier on we had these bullish divergences, these green lines where lower lows, momentum is pointing up, and that played out beautifully. Here, it's not exactly a lower low, it's basically a double bottom, but for all intents and purposes, the price was divergent from the momentum. The momentum was incredibly positive, both on the MACD and the RSI, making higher lows and higher highs, whereas the price was not reacting in an appropriate manner. As you can see, it spiked up very, very greatly right at the end of the 2014 year. And so that's my perspective on the one-day chart. You can't put too much into just looking at one chart. You have to take into account all the different variables that there are, which is, that's just what trading is, really. Give me a minute. Okay, and next up, I'm just going to do analysis on the weekly chart that we've got here, and I did some annotations on this. This is a weekly chart, so each candlestick represents 1 week of trading, and this goes all the way back to just after the 2008 market crash, so this is representative of the tremendous bull run that we've had for the past couple years. And there's a couple things that I want to point out. First and foremost, let's go over the divergences, right? I mentioned them previously on the one-day chart. The bearish divergences show up very well on the 1 week chart. And you can see that they've been playing out very well. You can see from 2013 all the way up to mid-2014, we had a very strong bearish divergence where the momentum is downwards, higher highs. And this doesn't look very significant of a drop, but this right here is about a 15 to 20% drop, not quite bear market, but it's a very sharp correction. Quite recently, in fact, we've had an even stronger bearish divergence where if you can see the momentum for the first high and earlier on this year was incredibly high on MACD and RSI, and then later on, right before this past pullback that we've had, made a higher high in terms of price, but the momentum has been down. And it's played out so far, and there's no indication, at least not on the momentum, that we're showing signs of reversal. But again, this is the weekly time frame, right? So any indication that could be a reversal could show up in smaller charts, it could show up on the 4-hour charts, the 1-day charts, the 1-hour charts. It all depends what your time frame is. But I will say this, we are still overextended on the weekly chart, even with this tremendous pullback that we've had. Just look at this chart for the past couple of years, right? This green line is still the 200-day, it's not the 200-day EMA, it's the 200-tick EMA. So basically that's each tick, or each bar is 1 week, so that's pretty much the same thing as saying a 1,000-day moving average, which it's very long-term perspective, don't get me wrong. But you can see that for the majority of this bull run, it has acted as the very bottom for it, where you can see all pullbacks end right there. This is right after the volatility of 2008 moving into 2009, so it's expected to be a little bit below there. That's relatively normal speaking. But since then, right, you can see that all these pullbacks bring it right down to this 200 tick EMA. Late 2010 comes right back to this 200 EMA, and it was a little bit below, but not by a significant amount. And then it shot right back up and had a bull run for about a period of 4 or 5 years or so. And again, we have some volatility. The market pulls back right to this 200 EMA. We have another bull run, we shoot up. But now the thing is, look at how far above this moving average that we are on the weekly chart. Look at how far above this MACD is compared to these different highs back here, where we were incredibly extended, at least from the bullish perspective, which leads me to believe that there's at least a pullback down to this EMA. But again, right, near term, the next couple days, the next week or two maybe, leading up to the end of the year, I think we're going to spike up. At some point in the following months, if I had to guess right now, I'd say there's probably about an 80 to 85% probability that 6 months from now that we've tested this EMA. But it's all up to you about how you want to trade and how you want to position your account. I'm personally going long. That's because I'm an active trader. if you see this, if you're a long-term trader, I would be hesitant to put my money into the markets, at least not long right now. It would be advisable to take out your investments and just hold cash right now. Cash is a very, very nice asset at this volatile market time period. And now going forward, even if we do come down and test here, we might just bounce right off of it and continue like previous here. Like these two pullbacks, you come down to the 200 and then you push up for a nice bull run. Maybe that happens, perhaps. The long-term charts would tell me that that's not going to happen. When I say long-term, we'll get to the monthly charts in a minute, but I'm favoring a lot more downside over the next year or two. Let me pull up the monthly chart. Okay, and now we've got the monthly chart, and so again, just like the daily and the weekly charts, each bar represents a month, an entire month, so incredibly long-term. This goes all the way back to, what does that say, 1990? I believe so. And so this is just I would not even consider this technical analysis. This is just very basic understanding of markets and how they function. But if you look at it from a very holistic perspective, there are very clear signs that we have more downside to come in the coming year or two, maybe even more. But that's my time frame right now for at least this impending bear market that I'm predicting. But let's just go through it, right? So this is from this bull market that we have indicated by this green line. All these green lines are bull markets. All these red lines are bear markets. It's pretty obvious. I probably did not have to explain that, but so let's start off with the first one. 9 years, the market was up 600% before we had a 2-year 50% bear market. Pardon me. Then we had another 5. This was the .com bubble, by the way, that burst early 2000s. Then we had a nice 5-year period run up of 100% gain, which is very nice for 5 years in the market. Then we had obviously the 2008 housing market crash, which was 1 year, 60% drop. And currently we've been an incredibly long and incredibly profitable bull market. And so if you just take that at its surface value, currently we've been in a bull market for 9 years, and it's been up 350%. And so if you don't put any context to it, you just work off those numbers, even that it should. I can't speak for you, but I know for me at least, it starts throwing up red flags. Like, okay, this cannot keep going forever, right? We're not just going to keep going green for infinity for an infinite amount of time. At some point, there's going to be a pullback. But usually, I shouldn't say usually, always there's got to be some sort of catalyst or some sort of bubble that pops for a market to happen. In 2000, early 2000, we had the dot-com bubble that burst. In 2007 and 2008, we had the housing market crash, and so that brings up the question: what could it be now? And it's very speculative. There's a bunch of different things that it could be. The most likely, in my opinion, would probably be the credit bubble that we have now. Companies, investors, banks—they're all borrowing incredibly high amounts of money. And the FOMC has been, actually that's another thing that I'll touch on right before we leave this video, the FOMC meeting coming up. But the FOMC, they've been raising the interest rates, and it can be taken a couple of ways, right? They're increasing the interest rates, and so perhaps that kind of deflates the economy, or not the economy, the market, I should say. Perhaps it deflates the market slowly, or maybe it just takes the air out of it a little bit, because right now we're obviously very overextended both in price and in time. And so maybe the rising interest rates will just deflate it rather than bursting the bubble. Alternatively, most bubbles need some catalyst to pop, and so maybe the interest rates are that catalyst that pops the bubble. It's hard to tell. You can only really tell once you give it time to play out, and we'll see in a couple of years whether it is. Right now, I'd be very hesitant to let my money ferment in the markets. I'm very positive, not positive. I already mentioned this, but there's no such thing as a sure bet in the market. But I think it's very probable that we have more downside. Also, it should be noted, the MACD does a very good job using the monthly the monthly charts. It does a very good job of highlighting the bear and bull markets. So the MACD histogram, that is, not the moving average comparisons. But let's look at the MACD histogram, right? we have these periods where it's red, it's overlaps directly with the 2-year 50% bear market. Likewise, sorry, pardon me. We've got the red histogram, correlates directly with the 1-year 60% drop. There's been a few whipshaws, like right here, you know, we had a year period of red histogram, but even still, even that wasn't very friendly in late 2014, early 2015. It wasn't exactly a bear market, but it still was it was a point in time where you would not want to be long the market, for sure, 100%. And you can see it, that we've had 2 consecutive red histogram bars now. And so, I mean, maybe it's another whipshaw. We had, you know, a couple small red ones there. We had a couple small there that were not indicative of a bear market, but even still, we're overextended in time. We're overextended in price. Now there's starting to be long-term signs that an impending bear market is coming. So my long-term outlook is that we're going to be coming back. Now, I don't think we're going to be having a 1-year 60% drop like we did in 2008. A lot of that had to do with the derivatives of the financial industry, which we don't have to the same extent or the same unregulated extent that we did in 2007, 2008. I don't see that being the foreseeable bear market, but I will say for certain that my long-term outlook is relatively bearish. I already mentioned that in the short term I'm positioned long, but that's me. I'm an active trader. You have to be able to make your own decisions. You have to be able to do your own analysis, but this is just my 2 cents looking at the market.